Yes.
All right, perfect. Welcome, everyone. Thank you so much for your time today from your busy days. We're here today in another session of Doors, Deals, and Dollars, where we bring you some information about how to use self-directed IRAs. We have an amazing speaker today, Jeff Dixon, which I'll allow him to introduce himself, but with several decades of experience, and really, really excited for this information because I know a lot of you have asked about IRAs, about what to do with it. You have maybe a dormant 401k and you're trying to see what to do with it. Well, this is the call that you can get those questions answered. And yeah, we'll have a Q&A at the end. If there's anything specific, I'm not sure, Jeff, if you prefer for people to ask as the questions come, or we'll leave it at the end.
It doesn't bother me if people ask questions during the presentation.
Okay, perfect. So just raise your hand or put it in the chat, and myself and Tiffany will do the very best in order to ask that and relay that to Jeff. I'll talk a little bit about myself. I'm Carla, as many of you know. I am a managing partner and founder at Goldman Capital. We are a multifamily investment firm, and just really excited to be with you all. You can check more about me and about what we do at goldmancapital.com. And now I'll just give it to Tiffany to talk a little bit about herself.
Good evening, everybody. Most of you guys probably know me. My name is Tiffany Lunt. I am a founder and managing principal of Lux Equity Capital. And but prior to syndication, I have been in the commercial banking and lending industry for nearly 20 years. And so with a very mission-driven approach to real estate investing, I specialize in structuring value-add multifamily deals that generate strong returns and long-term wealth for my investor partners. And as a first-generation American who grew up in Section 8 housing, I am very committed to transforming communities while helping others build generational legacies. Without further ado, I'm going to go ahead and pass it over to Jeff Dixon, who is our guest speaker today. Jeff, go ahead and kick us off with share with us a little bit more about yourself, and then and we'll go right into the presentation.
Perfect. Yeah, thanks everybody for having me on. I appreciate it. So I actually was in the mortgage industry myself for 30 years before I joined UDirect 11 years ago. So I had my fair experience with making loans for people. But what I've been doing for the last 11 years is sharing with people how they can use retirement funds to invest outside of the stock market. So UDirect's been around for 15 years now. Karen Hall is our founder and CEO. She started the company by herself, and in 15 years, we've grown to over $1 billion in assets with over 5,000 clients. And we just really enjoy helping people accomplish their financial goals.
Lovely. Thank you, Jeff. I will stop sharing now, and I will give you the hands-on to share your presentation. If it helps, there's the share button is right in the middle. It's like a little laptop with an arrow.
No, I've clicked that. It's brought up choose what to share, but I'm not seeing my PowerPoint presentation.
Maybe it helps with the entire screen. There's a tab on the top that says entire screen, and just click wherever your presentation is at.
Well, maybe I'm going to need you to start it. I'm not seeing it on here.
Okay, all right. I'll share it on my end. Just give me 1 second. All right, perfect. Is everyone seeing it?
Yeah.
Okay. All right. Amazing.
Okay. So let's start off by talking about what exactly is a self-directed IRA. Self-directed is a marketing term. It is not a different type of IRA account. And I get this question all the time. People will go to our website and they will try to, they'll create an account online and they're always like, I don't know which one of these to choose. None of them say self-directed. And it's because, well, self-directed is not the type of account. Self-directed simply means that we are offering retirement plans that let you invest outside of the stock market. So there's 5 different types of IRAs. We offer them all. I'm going to cover those in a little bit. One of the differences between a self-directed account and like a brokerage firm is at a brokerage firm, you're going to have an advisor, someone who's going to be making stock recommendations, trying to help you to grow your portfolio, but they're making decisions on your behalf. Now, they can't force you to do something, but they're going to try to steer you into not only what they think is best for you, but unfortunately what can be best for them and their company. That's completely opposite of what we do. We don't suggest any investment specifics. We can tell our clients the types of things they can invest in, but if they ask us for a name of a company or a person that they might be able to invest with, they have to find these on their own. We do not make endorsements or recommendations on specific people or companies. All IRAs follow the exact same IRS rules. Let's go to the next one. So the difference is just going to be the type of assets that an IRA is holding. So your typical brokerage firms, your banks, they let you do publicly traded stocks and bonds, mutual funds. A bank might let you do a CD. We're the exact opposite. We're not even licensed to hold publicly traded stocks and bonds. Our clients do things like buy real estate, they buy land, they buy existing notes, or they act as a private lender and make brand new loans to people. They invest in other people's LLCs or private placements or syndications. There's a number of different names these go by. Tax liens, tax certificates. Now, we can hold private stock, just not public stock, which is the exact opposite again, because the brokerage firms can only hold public stock and not private stock. And cryptocurrency has actually been something we've started offering out here during the last year. It's been interesting seeing the cryptocurrency, how it's just been going up and down. That is such a volatile type of investment. So do you have limits with what you can do? Of course, there's always limits with everything. So a self-directed account can invest in everything but life insurance contracts, which in the 11 years I've been doing this, I've literally never had one person say they want to invest in, but you can't, so it's off the table. You can't do collectibles like artwork or coins. You can't do cars. Actually, I had a guy just last week say, can I buy a airplane and I want to lease it out? And I'm like, no, it falls under cars and airplanes. Anything with wheels is considered a collectible by the IRS. You can't do antiques. So, these are just things that the IRS does not let you do with an IRA. And you also cannot invest in an S Corp, because only people can invest in S Corps. You can make a loan to an S Corp, but you cannot invest in one. There are what are called disqualified people to you, and that is yourself and your spouse if you're married, and then your up and down family tree line, like parents and grandparents going up, children and grandchildren and their spouses going down, and anyone you have a fiduciary relationship with. And what that gets into is these are people that your IRA funds cannot benefit. So while your IRA can buy rental property, you can't buy property you already own or that one of the disqualified people own. You can certainly rent out rental property, but you can't rent it out to a disqualified person. You can't make a loan to a disqualified person. There's only one thing you can do with a disqualified person. You could buy a brand new asset or invest in a brand new asset together that neither of you have any control over or any prior ownership of. That's the one thing you can do with a prohibited party.
And to get some clarification, the disqualified person is that the self-directed IRA cannot hold anything that is tied to those people, not that it doesn't benefit those people or that you could potentially benefit those people, or is it?
I didn't really understand the question.
The self-directed IRA, since you're investing in different types of assets, the assets that are disqualified are any that are tied to these.
Oh, to these people as well. Correct.
Yeah.
So like if your dad, was offering a real estate fund, well, that's great. Hopefully it's successful, but your IRA money can't go into it. There are also, so we've already talked about, that you can't benefit from this. You can't buy or sell property that disqualified people have. You can't provide goods, services, or facilities. Well, what in the world does that mean? So let's say that you're a real estate agent or a property manager, or you have you're a general contractor and you have your own company. You can't use these services on behalf of your IRA or prohibited parties. So if you're a real estate agent and your IRA wants to buy property, you cannot be the agent of record. You can't earn a commission or even a referral fee. You are not professionally able to be involved. If you have your own property management firm, you can't use it to manage the properties that your IRA has acquired. If you have if you're a general contractor, you can't use the people at your business to go out and do work on these properties. You just cannot. That's considered to be self-dealing, and you're just not allowed to do that. The IRS also has what they call the indirect rule, which is when people are attempting to circumvent a rule. So for example, you cannot make a loan to a parent, but you could make a loan to a sibling. Siblings are not prohibited parties. But you couldn't make a loan to the sibling who turns around and makes the loan to the mom. The mom ended up with constructive use of the money. She wasn't allowed to have constructive use of the money. As far as the IRS is concerned, it's still prohibited, even though you didn't technically make the loan to a prohibited party. You're just trying to get around the rule, and they don't allow that. We have a number of different blog articles on our website. We have one, of course, about avoiding prohibited transactions. So if you want to get more information afterwards, there's a wealth of information on our website in our blog section. So buying real estate is very popular with our clients. So let's talk about how that process looks. So the first thing you need to do is open up an account and get it funded. I can't tell you the number of times I've gotten on a call with someone. They're like, okay, I found a property, I'm under contract, I've given them earnest money, I have 30 days, I need to see if I can get an IRA opened up and have it make this purchase. Well, you've already started off with a problem, because the IRA has to be the buyer on the contract, and that contract cannot be assigned over to it. You can't assign a personal interest to an IRA. So that contract's going to have to be voided out. That earnest money is going to have to be refunded. And now you're going to have to enter into a new contract in the name of the IRA, and we're going to send out the earnest money deposit. And I get this all the time. It's like, but the contract has an assignment clause. It's like, that's not the issue. It's that you can't assign a personal interest over. So if you want to move forward on this, your only option is to void out everything and start over. And sometimes sellers aren't accommodating with that. Sometimes they are, sometimes they're not. So you really need to get the account opened and funded so that you're in a position to make an offer on a property when you find it. You're the one who's going to find the property. The IRA is the buyer. We assign a name to the IRA when it's opened up with us. You sign it, the contract, but you're sending it to us and asking that we send out the earnest money deposit. And you're also sending in a form of ours called a direction of investment, or we call it a DOI for short. And at time of closing, you're sending us a settlement statement with a request the additional funds are sent out. All of these documents are reviewed by our compliance department. If there's corrections needed, we let you know what those are. Once we've signed off on everything, we wire money to the closing agent. So now title is held in the name of the IRA. It owns it as an asset. Rents are made payable to the IRA, and all expenses are paid for by the IRA. So to make sure that the IRA has sufficient liquidity to cover any expenses of this property, expected or unexpected, we do require there be a 10% cushion of the purchase price, maxing out at $10,000. So anything over $100,000 purchase, you're going to need to have roughly $10,000 left in that IRA so it has sufficient liquidity. And of course, we have a blog article on our website.
Jeff, just going back a little bit earlier when you talked about that the IRA is not like other type of retirement accounts where you can hold public stocks. Can you provide a little bit of an understanding of the difference between private and public stocks, and if you can invest in a fund of funds?
So a public stock would be one that's traded on like the New York Stock Exchange, where a private stock it's not gone public yet. It's a private company. They can issue stock in their company, but since it's not a publicly traded commodity yet, it's considered to be private stock. And you'll see a lot of banks, they will offer like private stock options to employees, or businesses do this sometimes. It can be an incentive for an employee to invest in the business. And their goal is to hopefully go public one day. And if that happens, they don't have to move the stock immediately. But when they want to sell the stock, they're going to have to move it to a brokerage firm. We could hold the stock after it's gone public because we didn't buy it as public stock, but we can't sell it because we're not licensed to do this. So they actually, at that point in time, have to move the stock to a brokerage firm or bank. And at that point in time, they can start selling the stock if they want to. And I mean, they can move it before they want to sell it, if they want to just have it being held at a brokerage firm for whatever reason that might be. But does that help clarify that?
Yeah, I think so. Let us know, Rachel. And can you invest in fund of funds?
What kind of fund?
Fund of funds. And Rachel, if there's something specific that you mean by this, you can feel free to unmute and ask.
I mean, I'm not familiar with that term. If it's a private fund, yes, they can invest into it. Our clients invest in, private REITs, private syndications. These are all allowed.
Okay. Yeah. There's just so many different kinds of funds now that people are setting up. And they have different names, and I think legally they're set up a bit differently, but I know a couple people now that have done that. And then I've heard of like fund of funds, and there's like a couple other too. I can't think of the name of them right now, but it sounds like you can use the money to invest in those.
Yeah, as long as it's not a publicly traded investment,
Okay.
we'll be able to help with it.
No, I think they're private funds. Yeah.
Yeah.
And
No,
I think you do have to sign a PPM to be in them.
Yeah, that's very common with these
Okay.
investments.
Okay.
One more thing, Jeff. There are a couple of people here who have old 401ks, and they are thinking about transferring those to self-directed IRAs in order for them to, for example, buy real estate with those self-directed IRAs. Can you talk a little bit about that process?
I do have a slide later on there. I cover all of this. So
Perfect. We'll give it away.
okay. So here's an example of a father and son buying a house. And you might recall I said the one exception to prohibited parties was that they could buy a brand new asset together. So a father and a son could buy together, son using his IRA, the dad using personal cash. I mean, the dad could also use an IRA if he wants to, but in this case, we're just showing the difference between the two. The title reads, the son's name, legal owner via non-trust custodial IRA with AET, 50%, father's name, 50%, tenants in common. These are always tenants in common. That is the only type of vesting that's permitted. Now, it doesn't have to be 50-50. It could be 60-40, 70-30, whatever each of them are putting into it is fine, but whatever that initial percentage is determines how rents and expenses are split and paid. So if it happened to be a 60-40 deal instead of a 50-50 deal, and let's just say the dad had 60%, then the dad would collect 60% of all the rents and pay 60% of all the bills. The son would get 40% of the rents and pay 40% of the bills going into his IRA account. And that's why the title has to list the percentage, because it has to be, legally shown at that point in time. And the reason that it's okay is neither of them had any ownership of this property prior to buying it. So the disqualified person rule was not in play. But after they buy it, it does come into play. So neither of them could ever live in this property. None of them could do any physical work on this property. They can't buy each other out. Like if, the dad said at a later point, you know what, my son wants to get his IRA money into something else, so I'm just going to buy him out. Well, he can't. He's a prohibited party to you, so you can't buy him out. Now, the son could sell to his brother, who's not prohibited to him, and so he could do that, or he could just sell to a third party, but he cannot sell it to his dad, and he couldn't sell it to his dad's IRA either. So they need to make sure that they want to be in this property together. Now, can you use financing to buy these properties? Absolutely. The IRS does allow that. However, as with all things with the IRS, they have rules. So the only kind of loan that can be used with these types of deals is referred to as a non-recourse loan. And that just means that if the lender has to foreclose, all the lender can do is take the property. They can't go against the other assets in the IRA or against the individual personally. And that's because the account holder cannot give a personal guarantee on this loan. And there are not a lot of lenders who will make a loan non-recourse to an IRA without personal guarantees. Let's go to the next slide. So there's lenders that we know of who will make loans to IRAs under these terms. And then these also have to be portfolio loans, which means that once the lender makes the loan, they're going to be servicing it for the length of the loan. They can't sell it off. Most of these lenders want 30 to 50% down payments. These aren't going to be 20% down Fannie Mae loans. I'm going to give you my email address at the end of this presentation. If you would like, I'd be happy to email to you our lender list or any other information that we might happen to talk about here today. I'm happy to, continue on afterwards. Go ahead. Now, although the IRS allows financing to be used, it's not prohibited. It is a taxable issue for an IRA if they use it. So it's a tax called Unrelated Debt Financed Income Tax, or UDFI for short. And this also would come into play if they're investing in a real estate syndication or fund, and the syndicator themselves is using financing to buy property. Whenever there's financing involved in a deal, again, not prohibited, but it's a taxable issue that the IRA will now incur. And to kind of give you an example of how this works, this is not exact, but you really need to talk to a CPA if you're doing this. But let's say that it was 40% down and 60% financing, just to differentiate the numbers. Since there's 60% leverage on the property, 60% of the rents are potentially taxable. And your IRA will now start to file its own tax return, which is tax form 990T. You'd be listing 60% of the rents as income on this tax form, but you can also write off 60% of the expenses because, again, there's 60% leverage. So now it just depends on whether there's a net profit as to whether the IRA owes tax in any given tax year. And that 60% does not stay static. As the value of the property goes up and the loan amount is decreasing, that loan to value percentage is changing. So you're always calculating it on the new percentage each year. So over time, that's going to get better and better for you because that percentage is hopefully going to be dropping down. Now, if you sell the property and there's still leverage on it, then whatever the percentage of leverage is, the appreciation of the property will be taxed as well. So if you can actually pay the loan off before you sell the property, that's in your best interest because now there's no financing on the property at the time of the sale, so you don't have to worry about paying tax on the gain. You would have paid tax on profits as it was, year to year, but now that tax is not going to be applicable. Next one.
Hey, Jeff, before you move on to that, I do have a question in regards to that. So
Okay.
most of the syndicated deals in multifamily, oftentimes it is through agency loans where we will be able to do non-recourse. But one of the things about it is we maintain the structure to be usually like interest only payment for the 5-year hold per se. And because of that, by the time of the sale, we would be subject to having a loan that's still outstanding. And so because of this, what you mentioned of the, the UDFI and the which I think you're going to talk about the UBIT at this point too, it would be good for us to know what are some of the implications, or at least how do we navigate these type of taxations that will occur, because all of our deals will likely have a debt factor to it in the capital stack.
Well, there's not really a way to avoid tax for an IRA. If they invest in this deal and they're using an IRA, that IRA is going to be subject to this tax. Now, I'm going to be talking about solo 401ks in a little bit. Solo 401ks are actually exempt to this financing tax. So if someone is self-employed and eligible for a solo 401k, that is a way that they can avoid this tax. But there is not a way for an IRA to avoid this tax. Now, you could potentially structure the deal differently. Instead of them investing in a fund, they could potentially make you or the company a loan. I'm not saying you'd want to do this. I'm just saying, and at that point in time, they're not investing in a fund. They're simply being a lender themselves. Now, whether or not that makes sense in any way for you all, I couldn't address and wouldn't try to. But it would be a way that you could help IRA account holders avoid this UDFI tax. So UBIT, which is unrelated business income tax, this actually comes into play if an IRA is engaged in running an active business. And so, for example, an IRA could go out and buy a dry cleaning business. Now, the account holder couldn't run the business or draw salary from the business, but the IRA could own a business. But since it's now running an active business out of the IRA, the IRS considers that to be a taxable issue as well, and UBIT comes into play. Now, this is where it gets confusing for some people, is because there are a lot of people out there that will collectively call the financing tax and investing in a business UBIT. And you'll hear people say, and this is great because solo Ks are exempt to UBIT. No, they're not. Solo Ks are subject to UBIT. They're exempt to UDFI taxes. And by not differentiating the two taxes, it can confuse people down the road. So that's why we like to make sure that we're explaining this with the two separate taxes. And that UBIT is applicable to both an IRA and a solo 401k. So a solo 401k could, it could buy a dry cleaning business, but it's going to incur UBIT at that point in time. Now, if you are really bored at night or tremendously wanting additional information, you can read in IRS publication 598. It's also a great way to put yourself to sleep at night if you want to get more information on these taxes. So making a loan from an IRA is very popular. It's actually the second most popular thing our clients do. They rank in syndications, making loans, and then buying property. And I think there's a number of reasons for that. Generally, if you want to buy property, you have to have a lot more money in an IRA than some people have. But if you want to make like a second mortgage to somebody, or maybe get into a syndication where the threshold of entry may be a lot smaller, these become more viable for people to consider using an IRA for. But you could make a loan from an IRA. You could also buy an existing note. But if you're making a brand new loan, you're going to drop a note. And if it's a secured loan, a deed of trust, it's going to show the IRA as the lender. There has to be a rate of interest and a repayment schedule. It could also have what's called like an equity kicker, where they could share in the profit of the sale of the house after it's sold. So they make a loan, they get some interest on it. The seller sells the property, or the borrower sells the property at that point in time, and the IRA account holder also gets part of the profits from that if the note was drawn up to permit that. So that's very popular. If you're buying an existing note, well, then those documents already exist. What there would be is a bill of sale showing that the IRA is purchasing this note from whoever it's purchasing it from.
Jeff, there's a question here. When you were talking about the UB tax, so when people are buying a business, do they have to calculate that type of tax before offering a price on the business? Is that what you meant, Rachel?
Yeah, like is the UBIT part of the kind of analyzing the business before you buy it? Do you have to consider what somebody has to pay for that? Because how personally we're in tax brackets. So depending on how much you make, that's how much tax you pay.
Right.
If you're buying a business, how are you discerning how much UBIT you might have to pay on that business to calculate? Is that clear?
I think so. IRAs taxation is based on trust rates, not personal income tax rates. And I think the IRA trust tax rates are like 37%. It's fairly steep.
Okay, yeah, that's kind of the questions, like how they tax you. So you would have to kind of factor that into making as a profit on a business and what you're going to have to pay in taxes.
Yeah, I mean, we've had a number of people over the time I've been there that have called up, and inevitably it's like a bed and breakfast. They're like, oh, this is great. I'm going to buy this bed and breakfast, and I'm going to live there, and I'm going to manage the whole thing. And I'm like, well, first off, you can't live there and manage the whole thing, and you're going to be taxed because you're running a business. And if you finance this thing, you're going to be taxed twice. And they're kind of like, their faces just, really? I thought they figured out this tax deferred way of running this business. It's like, no, that's not going to work for you.
Yeah, I think at that point you need financial help from somebody who can go over all of the ins and outs of a business like that.
Right, absolutely.
Yeah.
Okay.
Okay, thank you.
Yeah, let's go on. So investing in syndications or private placements, this is actually the most popular thing that our clients do. And there's generally people are investing into an LLC. There's going to be an operating and subscription agreement. Sometimes there's a private placement memorandum. This all gets sent into us with our direction of investment. We review hundreds of these all the time. This is a very, very popular investment for IRA account holders. And they're easy to do. We generally knock them out in less than 48 hours, sometimes same day if it gets in first thing in the morning. And once we've seen new paperwork for a new syndication, if a second client wants to invest in the same deal, well, we've already approved this documentation. All that has to be done is the name of the IRA has to be changed. So, you know, it can be, these things can flow like clockwork. It's pretty fun. Okay. Now, if you ever look into this, you're going to hear people talk about what's called a checkbook account or a checkbook IRA. Now, checkbook IRA is a jargon term. IRAs never come with a checking account for the client. What this is actually referring to is the use of an IRA-owned LLC. So what you're doing is, after the IRA gets opened, that is always step one. You're going to have a third party create a brand new LLC. The IRA is the member of this LLC. You'd be the manager of it as the account holder. And once we've signed off on the operating agreement for that LLC, that's the asset that the IRA is acquiring, then you go and open up a business checking account at a bank of your choice, and we move the money from the IRA to this checking account. So now you'll actually make the investment in the name of the LLC as opposed to in the name of the IRA. But since the IRA owns this LLC, you're still underneath the umbrella of it being within a retirement plan. Now, why would you want to do this? There's a couple different reasons why. One is we sometimes have people who want to buy outside of the US. We sometimes have people who want to buy at auction, and we will not agree to hold an asset outside of the US. And an IRA can't bid directly at an auction, but this LLC can do all of that. So our clients set up an LLC, we move the money from the IRA into this checking account, and now they can go bid at an auction at their heart's content in the name of the LLC. They win the bid, they wire money over, they go over, you know, they want to buy a property overseas or invest in some kind of foreign investment, they can do so with this LLC. It has to be a U.S. LLC and a U.S. bank account. We won't fund outside of the U.S., so they can't open up a checking account in, you know, Costa Rica. Now, once the U.S. bank account has been set up, they then could open up a business checking account for the LLC in, say, Costa Rica, and transfer money from their checking account, the LLC checking account, to this other checking account, but we'll only fund to a U.S. checking account. Now, we don't create these LLCs, and the client is not allowed to create the LLC. That is a prohibited issue. You can't provide services to your IRA account. If you create the LLC, you're providing a service. We have a list of providers that we send to people that they can talk to and get this LLC set up. Or if they just want to use their own CPA or tax attorney, they're welcome to do that too. Although I've had a few CPAs that work for these clients that aren't familiar with this, and they're always calling up going, what are we supposed to do here? We've never done this before. And I'm like, you may not be the right person for this job because we're not legally allowed to tell you how to do this. So if you don't know how to do this, you may not be serving the client very well. Now, this LLC structure does not change any of the rules that I've previously mentioned. So you still can't work on properties. You still can't make loans to your mom. All of that's still in play. It's just that the money's sitting in an LLC checking account that the IRA owns, as opposed to sitting directly in the IRA account. Okay. Now, what if your IRA runs out of money? Well, that's mostly a problem for real estate, which is one of the reasons we want there to be that $10,000 cushion left in the IRA. But let's just say that there have been some huge expenses of the property. You've drained out everything in cash. There's still more expenses that have to be paid on this property. what are your options? Because you can't write a personal check for these improvements. So if you have earned income from a W-2 job or self-employment, you could make your yearly contribution. Maybe the IRA has bought some other assets that could be more easily liquidated, and you sell those and free up some cash. Perhaps you have a different retirement plan that you could bring over into the IRA with us and free it up. You could sell part of the property to a non-prohibited party and free up some capital. If you don't have financing on the property yet, you might be able to get a loan and free up some cash that way. But worst case scenario, there's really no way to bring more money in. The IRA just can't sustain owning that property, and it's going to have to sell the asset at that point in time and get out from underneath it. So it's really important to make sure that you just protect yourself by making sure you have sufficient liquidity to cover these things. Now, sometimes in syndicated deals, they have capital calls where they need to bring more money in. And if they haven't allocated for that, that can cause a problem too. Now, hopefully they've got more money in a different IRA that they can just bring over and then put into that same syndicated deal. But that can also cause a problem if they don't have additional IRA money. Okay. So these are the types of IRAs we offer. So traditionals hold pre-tax dollars and anyone can have one. Roths hold after-tax dollars and anyone can have one, although there are income limits to being able to make a contribution to a Roth IRA. Both the SEP and the Simple are for self-employed people. The Simple was the original self-employed IRA, and then the SEP got created later by Congress. And most people that are going between them go for the SEP. And the main reason is the contribution limits are substantially different. You can put 25% of business income into a SEP IRA. It maxes out at $70,000 this year, where your max contribution to a Simple, if I remember right, is $13,500 if you're under age 50 or $16,500 if you're over age 50. So substantially less than what the SEP allows. And an inherited IRA means that someone else had a retirement plan, you were the beneficiary of that plan, they passed, you inherited that assets in that plan, and that has to go into an inherited IRA unless you're the spouse of that person. A spouse has an option of putting it into an inherited or just into a regular traditional or Roth or SEP or Simple under their own name. And inherited IRAs have different distribution rules than the other types of IRAs. And in fact, Congress about 3 or 4 years ago really tightened up. You used to be able to take money out of an inherited IRA over your life. Now you have to take it out over a 10-year period. And that's it. You have 10 years, you got to wipe out everything inside of that IRA. So they really made it a lot worse for people that are inheriting these accounts in terms of being able to use them to have an income stream over the life of the loan. Geez, there's my loan officer tendency moving its head over your life. Solo 401ks is a 401k plan as opposed to an IRA plan. It's for self-employed people. The next slide is going to get into that. And then we also offer health savings accounts. This is a plan if you have a high deductible insurance plan. You can set up a health savings account, put money into it, which is actually tax exempt, and you can use those funds to pay for your if you pay for something, you can reimburse yourself, or you could pay for your deductibles out of this thing, and you're using tax exempt money to cover those. So it can be a good way to handle that. Now, solo 401ks, you have to be self-employed, and you cannot have any full-time employees with any business you own, not just the business you want to structure or sponsor the 401k plan, No business of yours can have full-time employees. There could be other owners, and actually a spouse can be an employee, and the IRS does allow that. But outside of a spouse, there can't be any other full-time employees. Now, there's two contributions you can make to a solo 401k, where there's only one contribution you can make to an IRA plan. So with a SEP, you can contribute 25% of business income, maxing out at 70,000. With a solo 401k, you can also make a 25% business contribution, and it maxes out at 70,000. But you can also make a personal contribution to a 401k plan. Now, where this can be beneficial is, let's say that your business only made $100,000 last year. Well, 25% of that is 25,000. You're not anywhere near the $70,000 maximum. So 25 would be the most you could put into a SEP. But with the solo K, you could make that $25,000 business contribution, and you can also make your personal contribution, because the two of them combined are what maxes it out at 70,000. And your max contribution to a solo 401k is 23,500 this year. So, if you put in 25,000 from the business and 23,000 from a personal, well, now you're up to 48,000, where the SEP was limited to just 25,000. So it's a way that you can get more money into it. You can contribute both pre-tax or after-tax, quote unquote, Roth dollars to a 401k plan. So the business contribution can only be pre-tax, but the personal contribution, you have the choice of it being pre-tax or after-tax. It is generally exempt to the UDFI financing tax. I say generally because I heard a tax attorney by the name of John Heyer speaking one time, and he mentioned that while solo 401ks are exempt to the financing tax, if you are using the financing for purchase acquisition or for home improvement, if you do a rate and term refinance, you're actually not exempt to the financing tax anymore. Now, I've never heard anybody else say this. I've talked to different people, and I've heard a few of them say, well, I can kind of see where he's coming from. And I'm certainly not saying he's right. I just don't know for 100% that he's wrong. But rate and term refinances in with a non-recourse loan is almost never heard of, because these rates don't really change ever. So most people do rate and term refi because rates have really dropped down and they're trying to get a better deal. Well, that just doesn't really happen with these non-recourse loans.
Jeff, we have two questions here. I know that our time is coming up. One of them is specifically about the solo 401k. The question is, can a solo 401k be set up for an LLC that is set up as a partnership? So the partnership would be that the partners are spouses.
Yep, it's fine.
Yeah. And then the next question is previously about the HSA, if HSA includes life insurance or just medical insurance.
Just medical.
Just medical.
And another nice feature of a 401k is you can take a personal loan from it, where you can never take a personal loan from any IRA account. Now, you can make a loan from an IRA or from a solo 401k to someone else, but you can only take a personal loan from the 401k plan, which is the lesser of 50,000 or 50% of the cash value in the 401k. It's paid back with monthly or quarterly payments over a 5-year period, like prime plus one. So you're actually paying back your retirement plan interest when you borrow from it.
I've used it before, and it has been such a life changer when I was starting out and trying to build, to be able to know that I could take that loan from my 401k and not have to worry about that I was paying interest. The only interest that I was paying is towards the 401k, which would just increase it even more. So that was great. Tiffany, you have a question?
Yeah, and I have a question as far as like the if you, in the same question that Giselle had here, where it's like solo 401k, you can set it up if you have a partnership with your spouse. But is there a nuance thing where if you were to have multiple businesses, like let's say yes, the partnership with your spouse, you don't have any employees or W-2 employees, right? And then, but you have other businesses that are kind of related and they have W-2. Is there a situation then that would disqualify you from being able to open up a solo 401k because of that?
Generally, yes, because any business that you have uses the same 401k plan.
Mhm.
So if you've got 3 different businesses, one business will have sponsored it, but all the businesses are participating in that. So if you have full-time employees with other businesses, then no, that doesn't, you're not going to be able to do it. Having said that, and this is an area that I know very little about, but I've talked to a couple CPAs who've tried explaining this to me. There is what's called a control group that the IRS looks at with your businesses. Now, if the businesses are considered to be part of the same control group, then they have to use the same 401k plan. But if they're not considered part of that control group, they actually could have separate retirement plans. So you could have 2 401ks at that point. Now, how do they make that determination? I don't have the vaguest idea. I'm not a CPA. I'm not going to pretend that I understand any part of this other than what I literally just said to you. But if you have multiple businesses, you might want to talk to a tax advisor and see if if they all fall under the same control.
Well, that's a good plug-in for us. And our next webinar is actually, we're inviting a tax or CPA that will be able to navigate these conversations a little more and dive in deeper on how this implications may work in regards to SDIRA or UBIT or the UDFI. So that's great. Thanks, Jeff. Always is a collaboration when it comes to different advisors. Everybody has different goals, and that's why all the more reason why it's important to have these type of advisors in your network to make sure that they all collaborate and they all talk to each other so that they know what your goal is, what you're trying to achieve, and then be able to collaborate in a manner that will be the most efficient and optimal way for you to save on taxes and not have any kind of surprises at the end of the year. But thanks, Jeff, for sharing that. And I think Mike actually has an additional question here. He's asking, what are some of the fees that are associated with maintaining an SDIRA?
Well, we have a slide that covers that. So give me a minute and we'll get right to it.
Perfect. Let's go on.
You can fund your IRA by moving money from most retirement plans. The type of IRA you open up is based off of the tax basis of the money you're moving over and whether or not you're self-employed or not. You can make annual contributions if you have earned income. And if you're married and you file a joint tax return, but you're not working, but your spouse works, then you can still make your own contribution. It's referred to as making your spousal contribution. So it's not made to your spouse's IRA, it's made to your IRA. You're just eligible to do so because you're married and file a joint tax return, and the IRS says, great, then you can still make a contribution. Okay? Now, if your funds are with a current employer, like a 401k plan or a 403b, the odds are you're not going to be able to move those until you've left employment. It occasionally is allowed. It's called an in-service transfer when it is permitted. It is not very common, but you could certainly ask your custodian if you can move the money with an in-service transfer. Don't expect a yes, but hey, sometimes it's yes. Okay. We have a number of different resources on our website. We also have a YouTube channel that you could go to where our CEO has uploaded dozens of videos of her speaking. We have a newsletter. You can always call and talk to us. And Karin actually has recently published a new book. It was promoted by Bigger Pockets, and it's an excellent book. I've probably read it about 50 times here, helping her navigate, making sure that there's not mistakes in the book. So I got to be a proofreader on this thing quite a bit. So it was kind of interesting. But yeah, we have a number of resources that can help out. Go ahead.
Jeff, can you quickly explain a little bit about the fees that are charged by you direct in order to?
Yeah, I'm going to. So, well, what happened to my fees? Oh, that's weird. Okay, so let's talk about fees. So for any account, there's going to be a $50 one-time setup fee, an annual fee. It's a flat $275 a year. It's not based on asset size or number of assets. You pay the first year in advance. And then there's minor costs of moving monies around. Wires are $15. ACHs are $10. Checks we send are $10. There's a $10 transaction fee when you make an investment, but you get your first 6 transaction fees waived. So you wouldn't see that on your initial deals. You would see check or wire or ACH fees, though they're not, those aren't, you don't get your first 6 free of those. But, and then if it's a solo 401k, it's basically the same. The only difference is, in addition to the annual fee of $275, that's if it's just holding pre-tax dollars. If you've made Roth contributions to this 401k, so there's 2 buckets of money, then there's an additional $50 a month annual fee for that Roth bucket. And there's a $400 plan binder fee up front to get the solo K plan set up. There's a lot of moving pieces with getting a solo 401k set up. An IRA, we can get created in 5 minutes. It's easy peasy. But there's a lot of work involved getting a solo 401k set up. So we do charge a $400 fee for that. And then the other miscellaneous costs are the same. And you would just go to our website and create an account. There's a few documents you need to send to us. You're going to fund it by whatever appropriate source. And then you'll be working with your dedicated transaction coordinator to help you make investments. So we have 3 transaction coordinators. We split our clientele list up by last name. Oh, there it is. I thought it was before that. Okay, there's our annual fees or our setup fees. And then the last slide should be my contact information. There it is. So the 949 number is my cell. You could call or text me. If you want to email me, jeff@udirectira.com. If you have follow-up questions, I'm happy to help. If you want me to email you anything, you can email me at this, and I will be happy to share that information with you.
Thank you, Jeff, so much. I know that we already reached our hour, but I want to just give you a special thanks for all of the information that you provided today, not only about the self-directed IRAs, but 401ks and every other type of question that we had. If anyone here wants to get in contact with Jeff, Tiffany went ahead and added his information in the chat as well, so you can see it better or just take a picture of the screen, whichever one you prefer.
How much can we start with? Like,
Oh, I try to type fast so we don't run out of time. Yeah, like how much can we contribute? Like, are we limited?
Yeah, so with
Like,
a traditional or Roth IRA, your max contribution this year is $7,000 if you're under age 50 or $8,000 if you're over age 50. If it's a simple IRA, it's $13,500 if you're under 50 or $16,500 if you're over 50. With a SEP and a solo 401k, you've got the 25% business income maxing out at 70,000. And with HSAs, I think it's 3,500 if it's an individual and 7,000 if it's a joint HSA for or not a joint, but a family HSA.
okay, so say I wanted to open a self-directed IRA to invest, I can only put like 7,000 in. So unless I'm rolling it over from, like, transferring it over from a retirement account, right? Like changing it and bringing it in, turning it into a Roth and then putting it in.
Yeah, there's no limit on bringing over existing retirement money, just on new contributions.
Okay.
And yeah, if you're not self-employed, then you'd be limited to a traditional or a Roth.
Okay. And would you recommend both? Like having both?
Well, you can't contribute to both each in the same tax year. Well, let me modify that. You can't max out a contribution to both a traditional and a Roth. So if your max contribution is 7,000, I mean, you could put 3,500 in a traditional and 3,500 in a Roth. We don't really see people do that very often. They seem to want to grow one account as fast as they can. So they focus on
Right.
putting the contributions into one account.
Yeah, that's what I would kind of think. Okay. And is that the same that applies to the solo 401k as well? Like you can't do both a self-directed IRA and a solo 401k at the same time?
You do a traditional or Roth and a business plan. So you could have a traditional and also a simple SEP or solo 401k. You could have a Roth or a simple SEP or solo 401k. You just can't have two business plans. So you can't have a SEP, a simple, and a 401k. Those are all competing against each other.
Okay.
And you get, as far as contributions, and your Roth and your traditional have, you have your limits. Now, one difference is you can contribute to both a traditional and a Roth as long as you're not exceeding the maximum for both. You cannot make a contribution to both a SEP and a simple, even if you're like, well, I'm going to put 35,000 in the simple or in the SEP and 35,000 in the. You cannot, absolutely cannot make two different contributions to a business retirement plan in the same year. So if you're going to have a business retirement plan, you got to pick your lane and run with it. Now you can always change it down the road.
Mm-hmm.
We've had some people open up SEPs and decide they want solo 401ks later, and that's fine. You just can't contribute in the same tax year. And once you make the switch over, that's, then the SEP would get closed down because you're going to move the funds from the SEP into the solo 401k.
Yeah, you want to kind of pick a lane and grow it like just on that one path.
Yep.
Okay. Thank you.
Mm-hmm.
Well, this concludes our webinar. Again, thank you, Jeff, for your insights, for your information, for answering all of those questions. I hope that myself and Tiffany hope that it was very informational and beneficial to everyone, whether you already have an IRA and you didn't know all of that as to what to invest in, or whether you're looking to open one yourself. You already have the fees, you already have the contact. Feel free again to contact Jeff at any time. In the chat, you will find, again, Jeff's contact information, his email, and his phone number. And you will also find the topic that we will talk about in our next webinar, the tax benefits of multifamily real estate investment. And we're going to have Matt from a CPA firm bring all of that information. So thank you, everyone, again, for your time. Thank you, Jeff, and have a good night.